Hello, my name is Julia Streets and welcome to the podcast series StreetsTalksTo. And in each episode, I interview leaders from some of the most influential firms, bodies and initiatives in the financial services industry. On each episode, we explore what's at the very forefront of innovation and change. We think about the challenges facing their clients and also the industry at large, and we uncover the opportunities that exist both today and as we look ahead. We hope you enjoy the series, which you can find on all good podcast channels, and all the episodes are listed on our website, streetsconsulting.com, and you can find the episodes using the hashtag StreetsTalksTo. And thank you for listening, and welcome to StreetsTalksTo X Margin. Trading companies want credit to leverage their positions, often at multiples of their original funds, and currently most trading requires them to make separate allocations of capital for each exchange where they trade. And in the highly fragmented crypto universe, lenders have little visibility to manage their risk, which is ultimately holding back growth in the derivatives and the cash crypto markets. So X Margin has developed a risk engine called X Margin Credit, featuring privacy-preserving software to unlock lending to institutions trading digital assets. And what this means is that they have more visibility and control to make margin calls, but also that borrowers over time can establish a credit score as well. And X Margin is one of the first solutions to deliver instantaneous credit scoring and risk monitoring across traders' entire portfolios, all the time preserving privacy throughout. So I'm delighted today to welcome two guests from X Margin. Our first guest is Darshan Vaidya, who is the CEO and the co-founder. He founded X Margin in 2019, following more than a decade of investing and trading derivatives products in cryptocurrencies, fixed income, foreign exchange, and oil. Now, prior to X Margin, he was CIO at the hedge fund Magpie Capital, where he oversaw market-making derivatives trading operations in cryptocurrencies for the firm's fund. And he also provided bespoke hedging strategies for large institutional cryptocurrency clients. So Darshan, it's great to have you on the show. Thanks for being here.
Thanks so much for having me.
Now, joining Darshan today is Matt Ficke, who is the COO and part of the founding team of X Margin. He joined in August 2020 from the cryptocurrency exchange OKCoin, where he was head of capital markets after almost a year working in business development. His trading experience stems from more than 5 years at Morgan Stanley, where he held various roles on spot, forwards, and non-deliverable forwards desks. So, Matt, thanks so much for joining us today.
Yeah, pleasure to be here. Thank you for having us.
Pleasure. Now, listen, I've been really looking forward to this because in the conversation about cryptocurrencies, the institutional world has most definitely woken up. The retail investors are involved, but when you think then it's not simply about trading foreign exchange, it's about the derivatives dynamics of the market as well, which is why I was really excited to have you on the show, because what I wanted to do is really not so much talk about what you're doing yet, because I've talked a little bit about that and I'm going to go into that in much, much more detail. But I'm really keen to hear that when you're out talking to the industry, what's keeping your clients awake at night at the moment? Darshan, can I come to you first of all on that?
Yeah, for sure, Julia. I think the main problem that clients face that we speak to, problems that I've faced myself running a crypto derivatives fund and are acutely evident in the market today through most of the trading firms that we speak to, if not all of them. And essentially that is the lack of credit that's available when trading firms are trading across multiple venues. You can have offsetting positions across multiple venues, and yet you have to place collateral at each one. And this is an expensive and inefficient problem that ultimately reduces the liquidity and stability of the market. And this capital efficiency problem is made worse because of the fact that the credit markets in the space are extremely inefficient. Ultimately, lenders have very little visibility into the risks that they're taking on when they're giving credit to a trading firm. And it's very hard for them to capture that risk. And for borrowers, as a result, there is a huge spread and cost to that credit. So when they go to access credit from one of these lenders, there is a premium, and the spread that a lender has to capture is significant because of the fact that the risks are so high. So what we're looking to really help them with is trying to solve that problem where they are looking to get capital efficiency across their operations, but in a cost-effective and competitive way, which just doesn't really exist at the moment in the crypto space.
And that has real impact in terms of collateral management as well. Matt, can I bring you in here? You're out talking to clients all the time. I'd love to hear your thoughts about what they're particularly engaged with you and those problems that they're really trying to solve.
Yeah, so on a high level, I do think our clients are constantly thinking about accessing different market opportunities, both in CeFi and DeFi, in a secure and cheap way. Broadly, I think it's difficult for trading firms to deploy infrastructure that allows them to be flexible across these opportunities, which are often pretty short-lived. And on top of that, they have to maintain an acute focus on risk management and capital efficiency. Because of the broad fragmentation and infrastructure limitations in this space, there's a high demand for capital and dollar-linked assets. A lot of times that's a function of basis trade opportunities on international derivatives exchanges. And also there's a substantial interest in using productive assets as collateral to absorb additional capital. Productive assets broadly being those on exchanges or currently active in DeFi protocols.
And you mentioned there about CeFi and DeFi. Just for the benefit of our listeners who may not understand necessarily the jargon of the industry, would you mind just explaining what you mean by those?
So CeFi being centralized finance, where typically one entity is operating an exchange platform, and DeFi being decentralized finance, which are open protocols available to the entire ecosystem and where we've seen a lot of growth in the past year or so.
And everybody's talking about DeFi at the moment, so thank you for the definitions. It really helps to define and to clarify what we're talking about in this world particularly. The world is never static. I mean, things are always changing. Darshan, let me ask you, what's changed particularly in the last couple of months?
Yeah, I mean, we've seen in traditional financial markets hunt for yield, as yields are still fairly compressed relative to the crypto market. And as a result, people are looking at the crypto market and trying to capture yields from that space. And the reason the yields are high in crypto is for a number of reasons, but amongst that, there is a lot of fragmentation in the space. And so there's just a lot of opportunity for trading firms that are looking to borrow, and hence their appetite to borrow is quite strong, and the amount that they're willing to pay is much higher than they would in traditional financial markets. And then because of the natural structure of the market, the steep forward curves, so retail and institutional demand is driving a market structure which inherently means that investing in crypto markets generates a significant yield. So you can justify quite high yields in the crypto market, but the risk is, where do we allocate that, and how do we allocate funds into the crypto market, but still have a good understanding of the credit risk that we're taking on when we are allocating funds to counterparties in the crypto space. So how do you access crypto yields and yet still maintain a handle over the credit risk that comes with that? So yeah, that arbitrage between the two worlds has driven a lot of the dynamics in the crypto space.
I would also add on top of that we see an increasing amount of DeFi protocols extending under collateralized credit. So examples of those are Maple, Clearpool, TrueFi, and all of those are looking for solutions to calculate, monitor, and reduce credit risk. Most of the large popular DeFi protocols today, like Compound and Aave, are open systems, and therefore they require over-collateralized borrowing, which negatively impacts someone's overall capital efficiency.
So Darshan, as you look ahead a little, do you see these dynamics continuing, or do you expect the world to shift further?
Yeah, I think naturally these worlds will converge, where the high yields in crypto that we see today and the spread between traditional finance, we expect that spread to narrow. But ultimately, there is still this booming demand for credit in crypto. And so it's more likely that we're able to bridge it in a way where we can deliver some of those yields to a traditional financial market as opposed to necessarily compressing the yields in crypto. We think that some of the things that make that bridge possible are down to an increased automation with bilateral due diligence. And then we expect the ability for some of the larger incumbents to charge a huge spread between the traditional finance world and the crypto world. That ability narrows. And so, yeah, we expect those margins to narrow, but it's not necessarily the yield straight away. I think we expect those opportunities to stay about as the crypto market continues to boom.
And there are always kind of two sides to every equation. One is the profitability and the yield, and one is the cost that's required to service the market, if you like. So it's interesting here you talk about, the spreads being some of the costs that are inherent with that and how that's going to shift as well. Matt, would you agree with that?
Yeah, actually, often we discuss a progression we saw in the spot market, where basically you see spot market liquidity move from a dealer model where the consumer of liquidity, the taker of the price, faces a bilateral counterparty principal price stream. And that's moved to solutions like a Tagomi or SFOX or FalconX, where the liquidity is aggregated and the taker has multiple price streams that they can trade against. And generally, we think the same thing will happen in the lending market, where today all there is principal price streams. And what you'll see that develop into is aggregated liquidity and direct market access.
And if we look at markets in general, we think about how that aggregation has had a massive impact over the years in other asset classes and more traditional market infrastructures as well. It'll be really fascinating to see how that bears out in the crypto market as well. So Matt, let me stay with you. And as we're thinking about how all these dynamics are playing out, I wonder if there are some things we might be overlooking. Are there some things that really should remain central focus now, or are there things being put on the back burner that should not be ignored?
Yeah, the market's moving quickly, and so there are a lot of opportunities. And I think what that has created is an environment where the standards for due diligence can be surprisingly limited. Broadly, we think that the industry can improve due diligence in terms of credit risk and overall monitoring of risk. And we think that in a more detailed sense, there's a limited understanding of certain asset or credit concentration risk across counterparties. And often market reputation, basically having a strong brand name, is too large of a driver of due diligence.
It's interesting, isn't it? Because there are new entrants coming through. There are new players who are dominating, and brand is often seen to be a major component as well. Darshan, let me ask you a similar question, actually, which is, what do you think that we, in addition to this due diligence and risk focus that Matt was explaining, what else should we be paying attention to?
Yeah, I think what Matt said about brand name playing too strong a role, on a similar vein, what is considered in the crypto market to be a quote unquote risk-free rate is still significant counterparty credit risk that is largely unregulated and uninsured. And the risks there are somewhat opaque and undervalued relative to risks that are fully transparent and controllable. And so I think it's interesting to me that there is still this underappreciation of counterparty credit risk in a market that prides itself on being permissionless and decentralized to some extent. There is still centralized warehouses of this credit risk. And I think that's something to keep an eye on, where transparency of that risk, similar to how Matt described, is something that can actually alleviate a lot of those concerns.
So what I really want to get into now is, you've painted so beautifully, kind of what's keeping your clients awake at night, what people are really thinking about, some of the changing dynamics in the market. I really want to get into what you do to help solve these challenges as well. Darshan, can I come to you first of all? When you are working with clients, how are you helping them address these challenges?
So, to look at what we're doing, perhaps let's look at the traditional solution for trading credit, which, even though it's largely unavailable for crypto derivatives, regardless, if we were to explore it, it involves a central intermediary or prime that provides you with the sole point of access to the market, where you access the exchanges it supports and has accounts at. And they act as the sole source of credit for you. They view your risk in real time, provide you credit based on those metrics, and then underwrite that credit by being the central counterparty. That's like the general structure. And what Xmargin's looking to do is unbundle that stack and essentially make the back end of a prime solution that's open and competitive, like a market for credit, letting any pool of credit earn a yield in a secure and transparent way. So how do we do that? We essentially are able to calculate someone's risk in real time, but without having to see the underlying infrastructure. And as a result, are able to be a neutral oracle of someone's risk, allowing any lender to evaluate someone's creditworthiness in real time, but without having to see the sensitive information about positions and trade strategies, which obviously trading firms are keen to keep private. And as that neutral oracle of someone's risk, we're also able to restrict where that credit can flow, giving lenders that extra degree of security in terms of worrying about whether the ultimate borrowers or trading firms are going to be able to effectively run away with those funds. And so what we're trying to do as a company is make that market for credit more open and competitive.
So Matt, I love the way that Darshan frames it as being the oracle. So tell us about how that sort of works.
Functionally, our solution helps capital allocators automate due diligence and access more information that helps them identify potential risks across counterparties and in aggregate. What that ultimately drives, as Darshan mentioned, is a more efficient credit market. We think we can help lenders better price credit, and we think we can help borrowers access more competitive credit through increased connectivity to informed capital.
A lot of this obviously is being driven by regulation. I think about all the conversations that I have about digital assets and cryptocurrencies. The question of regulation and what's going to come next comes up all the time. So I would love to ask you whether you have a favorite piece of regulation or a piece of policy you're particularly paying attention to right now. Matt, can I come to you first of all?
Yeah, I don't think any of them are our favorite. There are maybe two that we are actively following. The first is stablecoin regulations. We think that's been in the headlines a lot recently, and if there is broadly a chance that any regulation there limits the accessibility or mobility of stablecoins, it should have a significant impact on the credit market. There's a particularly large demand for stablecoins as they can be used on international derivatives exchanges. Yeah, the second one we're particularly paying attention to is the state level activity challenging interest-bearing accounts offered by the likes of Celsius and BlockFi. Retail is typically a cheap source of capital for those principal dealers, and a substantial change to their ability to take in that capital would definitely impact the availability of credit.
Interesting. It'd be fascinating to see how that all rolls out. And Darshan, I mean, I'm sure, I like to think you spend all your time poring through the books of the regulators and the codes of conduct. What sort of regulation and policy, building on Matt's remarks, are you paying attention to?
Yeah, I think what's really interesting is how institutions are looking to interact with DeFi and what it means to be lending directly to or investing in DeFi applications, and what the legal structure looks like when interacting with a DAO, for example, as opposed to an entity, or with a protocol as opposed to with a fund. And so these are things that are legal challenges and somewhat regulatory, but very much legal challenges that people will have to come up with scalable solutions for. But those are things that are very much top of mind for us as we look to interact with a lot of these different entities and try and form a bridge between the institutional world and the crypto world.
And there is so much discussion at the moment about some of those frameworks, some of those policies, some of those codes and pieces of regulation that are going to come through. It's very interesting to get your thoughts on particularly where people should be focused as well, because certainly as people are trying to figure this out, it feels like you should definitely have a seat at the table, if I should be quite so bold. But then for the benefit of all the listeners, I hope you're enjoying this conversation as much as I am. This is StreetsTalksTo X Margin. And in case you're wondering where you can find all these episodes, it's on streetsconsulting.com and using the hashtag StreetsTalksTo. And right now I'm talking to X Margin and having a really interesting conversation about the world of crypto trading, and particularly thinking about margin, thinking about risk, thinking about credit, and how actually as an infrastructure play to unlock that market in order to deal with the demand that's coming in, but also to serve the trading energy that's almost kind of flowing through it, is how it feels to me at the moment in the institutional world as well. But I'd love to hear your thoughts really as you look ahead. So this is being recorded at the end of 2021. We've been through a pandemic. Hopefully we're coming out the other end, but who knows? And as we're heading into 2022, I'd love to hear from you about what you're particularly thinking about as you look ahead. Darshan, as CEO of X Margin, what's on your mind?
Yeah, so X Margin is particularly focused on solving this problem of facilitating credit to trading firms in the crypto space and beyond. And that falls into two buckets, really. One is improving the infrastructure that evaluates credit risk, which relies on privacy-preserving technology, cryptographic proofs, and then a distributed architecture of these oracles of someone's risk. So we're continuing to build that out as we decentralize our oracles of risk. We become a more neutral assessor of someone's credit risk, but in a private way. So as we build that out, that essentially acts as the base layer or underlying technology that can then power an exchange for credit. And that's the second pillar that we're working on, which is essentially improving the visibility of someone's risk in real time through that architecture. And then in turn, being able to deliver a sort of credit score on any borrowers. And then improving the layers of control that we can limit the flow of credit once it's been extended. So reducing the credit risk further. And we work with leading custody solutions like Fireblocks, Copper, Greedo, and Gnosis. And we are looking to leverage their technology to be able to enforce that control. So that's our main focus over the next 6 to 12 months.
And it's going to be really fascinating to see how that sort of continues to grow and grow and grow, because these are really essential pillars to a well-running marketplace, in my opinion. And Matt, I said earlier you're out and about talking to clients all the time. What advice do you give them as they start planning ahead for 2022?
Yeah, so we advise all our clients to build a credit history and a profile. So effectively get set up on our platform. We also tell them that in our experience, we see the use of infrastructure pieces that are trusted by the market as beneficial to clients' ability to access credit. So working with the partners that Darshan mentioned helps firms access more credit because it conveys reduced operational risk. The last thing is to establish multiple credit counterparties. We're pretty amazed by the inefficiencies in this market, and we think that infrastructure that facilitates a more competitive credit market can ultimately remove them.
It's been wonderful having you both on the show, because a lot of people talk about what's going on in the derivatives trading market. There's certainly a lot of interest in how it works, how it functions, but there are clearly some quite systemic concerns about the inefficiencies that exist, but also the potential. And it's great to hear your thoughts about, the credit is so important in facilitating the growth of the market. So Darshan, thank you so much for joining us. It's been great to have you on the show.
No, thank you. It's been a pleasure. Thanks for having us.
And Matt, thank you so much for all your thoughts today.
Yeah, thank you. I appreciate it.
So, and thank you to everybody who's been listening. I hope you've enjoyed the conversation as much as I have. So I've been talking to X Margin. If you want to find out more, go to their website, www.xmargin.io, xmargin.io. Also, you can find them on Twitter at xmargintrading and LinkedIn x-margin. I've been Julia Streets. Thank you for listening, and we look forward to speaking to you again soon.
This episode of Streets Talks 2 was produced by me, Kieran Yates, on behalf of Streets Consulting Limited. Streets Consulting is a business development, marketing, communications consultancy that's focused on helping fintechs from the smallest startup companies to some of the world's largest global organizations. Everybody's trying to innovate and everybody's trying to grow. You can find this episode on streetsconsulting.com and using the hashtag StreetsTalksTo. We can be found on LinkedIn and on Twitter at StreetsConsult. Thanks for listening.